I am into mutual fund distribution since 2004, working for someone. 2009 I started off my own. Today we are handling around 2,500 customers and around 650 crores of public money. This last 4-year rally, every year, every day we will learn something new in this highly dynamic industry. But one thing, a kind of a cultural shift, I don't know, but it's a reasonable shift where customers are asking, why I should invest only in mutual fund? Is there anything else? Why I should not directly invest in mutual fund? Why I should not directly invest in stocks? And I will give you some money, you trade on behalf of me. You keep some percentage for all your service. I think we should be able to earn more. This is really risky because we have a reasonable history. You are into this for 25 years. And because of our very business, we have seen these numbers. If you keep US as a barometer, we have seen so many ups, downs, depressions, recessions, so many things. But there is a huge enthusiasm. There's a lot of interest built up. But historically, this is the time where that FOMO kicks in, fear of missing out. People will come, dump. They will, by seeing that last 3-4 year returns, they think that it is very easy for them to make money. With your experience of last 20-25 years, you have to educate our viewers on how exactly they should look at risk, how exactly they should, or better way to tell is they have to quantify the risk, what kind of return expectation they should come in, what is that they are missing in today's historical returns of 20% or 25%. Some schemes have doubled, tripled in last 2-3 years. This all makes us to forget that our lengthy history. A crisp way where our investors can hear from you what all things that they should keep it in their mind about risk, return expectation and time horizon. This is my question now.
Yeah. So if you look at how equities behave, equities always behave in a very, very volatile manner.
Okay.
The returns are generally superior compared to other asset classes, but volatility is always higher. And what has happened in the last 4 years, they have been unidirectional. Wherever you have invested, you would have made money subsequently. So it has given a lot of confidence to investors that anybody can invest and returns will definitely come. Those are very, very abnormal times, I would say. And as we have seen cycles of 20-30 years, there will all be ups and downs. I mean, forget 20-30 years. Even before COVID, for a good part of 3-4 years, the mid and small caps had underperformed large caps.
Correct.
But since there is a recency bias, people may tend to believe that mid and small caps will always outperform large caps. That's one of the other myths.
18 to 20, actually they have given huge negative returns.
Correct.
The data
So
is available.
These are all cycles and you need to manage your risk all through these cycles. The way to look at it is, if you do a business on your own, there will be ups and downs, there will be cycles, but you will not stop that business. You will keep putting effort and you will try to grow that business because you are building that business probably for your next generation as well. Even here, it should be looked at the same way, that you are building wealth for not only you and your family, but also for the next generation. And the only difference being, you are not running those businesses yourself. There is a set of other entrepreneurs who are running those businesses. And also you are not taking a bet on a single business, you are taking a bet on multiple businesses. And if you are coming through mutual funds, there is also a professional investment team, as I explained earlier, which does research, which provides research inputs. And there is a way to manage the overall portfolio risk in a professional way.
Yeah.
That is the advantage of a mutual fund. If you are doing it yourself, you can do it, but only thing is it has to be your primary job. You should be able to analyze the businesses, understand the risk involved, and you should be able to devote 24/7 time.
Do it full time.
It's a full-time job. If you're able to do it yourself. But otherwise, it's better to give it to a professional team to manage that money.
It's a fair understanding with which that investor should start.
That's right.
So if he's specialized in his particular job or profession or his business, I think he should put more time on his business, which will give him more returns or income, whatever it is, whatever he deserves in his business. And trading or buying and selling as a part-time may not be a great idea.
That's true. And also many people, when they say I traded and I made money, they don't compare the returns on a full portfolio basis, or they don't compare it to whether those returns are optimal or suboptimal.
Okay.
They just say that I've made money,
Okay.
right? How much money did you make?
Okay.
For example, we keep hearing this point that IPOs have been making a lot of money for investors.
True.
Do we know how much of allotment takes place in those IPOs? How much wealth are you able to generate by making IPO investments?
Correct.
Right. Finally, you need to look at your entire portfolio of wealth and see whether you are making optimal returns or not. So that's where if you are doing trading, it should be a 24/7 job, and you should be able to generate superior returns on your entire portfolio. Not on a specific sum that you have traded.
So practically you are telling that आपका जो जितना भी आप उधर जान डाल के कर रहे हैं, for that you are getting the optimal returns. You don't be happy with one or two of your decisions went right and don't
Correct.
jump the gun. That is what is the conclusion.
Exactly.